In recent weeks, Jerome Powell at the Federal Reserve and Christine Lagarde at the European Central Bank have commented on the likelihood of implementing digital currencies in the next years. The positives have been well explained. More transparency, ease of use and lower cost. The European Central Bank has stated that a digital euro would guarantee that citizens in the euro area can maintain costless access to a simple, universally accepted, safe and trusted means of payment. The digital euro would still be a euro, like banknotes but digital. It would be an electronic form of money issued by the euro system, the ECB and national central banks, and accessible to all citizens and firms. A digital euro would not replace cash, but rather complement it. The euro system will continue to ensure that you have access to euro cash across the euro area. A digital euro would give you an additional choice about how to pay and make it easier to do so, contributing to financial inclusion alongside cash. In the United States, many voices call for a digital dollar to compete with China's yuan. However, the US dollar is already the world reserve currency. It is used in more than 80% of global transactions, while the yuan is used in less than 4%. According to the Bank of International Settlements, the total is 200% as each transaction involves two currencies, and most payments and transfers are already electronic. The euro is the second most used currency and is also mostly through electronic transfers. One can say that the US dollar and the euro are already digital. As the global financial landscape continues to evolve, CBDCs have emerged as a significant topic of discussion. In this segment, we will explore the economic, financial, and human rights risks that come with the implementation of CBDCs. It is crucial to understand these risks and their potential implications to make informed decisions about the future of digital currencies. Let's dive in. The key economic risk is inflation. A CBDC can be created at the press of a button and distributed widely, inflating the money supply without any corresponding increase in GDP. This risk can be mitigated by issuing CBDC to individuals and businesses only in return for bank deposits, or collateral paid for with bank deposits, and to government only in return for bonds that have a reasonable chance of being repaid through taxes. Alas, since governments control central banks, this risk can never really be mitigated, and as seen with quantitative easing and today's rampant inflation, governments can always find ways to create money to spend. With CBDCs, the temptation to do this will only increase. The second economic risk is a large-scale misallocation of capital and effort to implement a CBDC. CBDCs require nationwide infrastructure for distribution and payments, and this needs to be in place for CBDCs to be useful. The private sector is best positioned to provide this infrastructure, but there is a risk CBDC infrastructure is designed and built by bureaucrats separate to private sector initiatives, resulting in low adoption of CBDC caused by poor utility and poor user experiences. Financial risks include exchange rate risk, higher lending costs, and operational risks. A CBDC should be just another form of central bank money, but could governments be tempted to exchange it for current forms of money in the national currency at less than 1-to-1? CBDCs could result in higher lending costs. In its recent discussion paper on new forms of digital money, the Bank of England identified increased lending costs as a risk resulting from a decrease in bank lending with CBDC and an increase in more expensive market-based financing. Then there is the risk of a centralized CBDC system suffering outages and cyber attacks. Even a short outage could badly affect the whole nation by disrupting everyone's financial transactions. If designed inappropriately, CBDCs have the potential to be used as tools of surveillance and control by governments. Every transaction is recordable, and any authority with access to the CBDC ledger could see all transactions. They could also control individuals through the ledger, such as putting expiry dates on their CBDC, limiting how much they can hold, varying interest rates and prices depending on who they are, preventing purchases and automatically deducting fines. The combination of digital identity and CBDC is also a big risk. Access and addressability are needed for digital payments, but these are different to digital identity. In a world of programmable money, digital identity can go beyond just enabling access to your funds. Use of those funds can be made conditional on attributes of your digital identity. If those funds are in CBDC, then the central bank and by implication, the government can control directly how you spend and receive money. Be wary of anyone advocating for digital identity to be connected to CBDC. While digital identity is needed to find fraudsters, money launderers and other criminals, there is no monetary reason to combine CBDC with digital identity. As we conclude this examination of CBDC risks, it is evident that careful consideration is required in the development and implementation of these digital currencies. Balancing economic stability, safeguarding financial systems, and protecting individual rights are paramount in harnessing the benefits of CBDCs without falling victim to the associated risks. With ongoing discussions and advancements in this domain, it is crucial for policymakers, financial institutions, and individuals to stay informed and engage in constructive dialogue to shape the future of digital currencies in a responsible and inclusive manner. Stay tuned for more insightful discussions on emerging trends in the world of finance and technology.